I indicated in the memo, we don't know what's going to happen with inflation. First of all, we're having inflation. And the question is, will it continue for a long time or will it be short term? Short term, I take to mean a year or so, and long term would be 3 to 6 years. And nobody knows. And anybody who says they know which it's going to be is either deceiving themselves or deceiving you. But but even not knowing, you could say to yourself, you know what? I'm worried about inflation. I don't know if it's coming or if it's going to be permanent long term, but I want to make some preparations. Now, the preparations you'll make are not exactly the same preparations that you would make if it was possible to know exactly whether the inflation will be long term or not, because you don't know. But you may make some preparations. So you may own floating rate debt rather than fixed rate debt. You might buy apartments because maybe landlords can pass on rent increases. You might buy the stocks of companies where earnings grow, where they can grow earnings faster than inflation. So have real growth. And I would not advocate a wholesale change of portfolio, sell everything you have and buy a whole new portfolio, because we're not sure and because that kind of transaction is very expensive. But at the margin, you could sell some fixed rate bonds and buy some floating, or you can sell some bonds and buy some stocks of growing companies and so forth. So, there are things that you can do to prepare for the uncertain future, even though we don't know what it holds.
Don't forget to like and subscribe if you haven't done it already.
This is a very unusual cycle because, we had some very profound effects last year and into this year, which were non-cyclical. They were exogenous events. You understand the word exogenous? They came from outside. Most cyclical developments are internal to the market. In other words, things go well in the economy, people get optimistic, prices rise, and once they rise too far, then they have to correct. So then they turn down, and then they fall through the fair value to the point where they're too cheap. And then when it's too cheap, they correct and they move back toward full value. So it's all about excesses and corrections, excessively high, excessively low, and then correct back to the mean. This cycle had nothing to do with any of that. These events, it's like almost like a meteor from outer space hit the earth. We had a pandemic. And because of the pandemic, we had to close most of the economies of the world to control it, to reduce social contact. So we had a very serious economic slowdown. And we had a market decline. And then, of course, none of that was normal cyclical behavior. Then, to fix it, the central banks of the world, including the Fed, plus the U.S. Treasury, went out and gave out money. They distributed money, they spent money, they made loans, etc. And the markets responded very favorably. None of that was normal cyclical event. So I'm just giving you this background. We can't really talk about it as how does this compare with other cycles, because this is not really a cycle in the sense of what I've written about in the past. So the interesting thing worth noting is normally the economy and the markets move kind of together. Not exactly together. There are leads and lags, but they move in sympathy with each other. So when the economy does well, the stock market does well. Sometimes the stock market anticipates a decline, but when the economy declines, the market does poorly. So they move kind of together. In this case, we hit the high February 19th of 2020, 3386 on the S&P, I think. Then 5 weeks later, we hit the low, March 23rd, 2260 or something like that. So the market was down a third in 5 weeks. But then it started up, and it went up in April and May and June. Now remember that the April, May, June, that quarter was the worst quarter in history for GDP in the US. So we have GDP collapsing down 1/3 at an annualized rate. It wasn't actually down, you have to understand, it wasn't down a third. It was, if you annualize the decline, it would come to a third. But you have the economy collapsing and the stock market booming. And this has continued. So the stock market is more than double where it was at the low in March. The economy is, slightly better. That's very unusual. Now, what does it mean? Well, you could say, I'm worried because the economy hasn't done well, but stocks are already high. Stocks are ahead of themselves. That's the negative way to look at it. The positive way to look at it is, yes, it's true, stocks are high, but there's a lot of economic growth yet to come. And we're just at the beginning of an expansion. And we believe that there won't be a recession for years. And so this is in investing, almost everything can be viewed either with a negative bias or a positive bias. And I've just shown you both of those. But that's where we stand cyclically. But let me say one thing, Samuel. It's always hard to see the future. There are two kinds of times: when we think it's easy to see the future and when we think it's hard to see the future. But I would say that when we think it's easy, we're kidding ourselves. It's never easy. And in fact, one of the most dangerous things is when you think it's easy, when you think you're sure you know what the future holds, that's how you can get in trouble, because you make big bets which could be wrong. But anyway, it's hard to know. And, first of all, we have shortages. So cars are in short supply. So car prices are high for new cars, which are hard to get. And because new car prices are high, old car prices go up because that's, they're substitutable. Then we had, when people came out of their isolation and they wanted to buy new houses, obviously not too many houses were built in the last 2 years. So we had a shortage of housing. So everybody starts building houses. When everybody's building houses, then there's a shortage of lumber. So lumber prices go up. And so this is how the economies work. Of course, one of the things we have now is a shortage of labor. And there's a variety of reasons. There are still millions of people out of work, but not for the jobs that want people. So people are changing jobs to get more pay. People who aren't working, businesses are enticing them to come back to work with big raises and bonuses and so forth. So the cost of labor is going up. So all these things in the economy look inflationary. And the question is, will they get fixed? Once the supply chain is working positively, and once everybody who's going to come back to work has come back to work, will these things settle down? And it's hard to know. Inflation is in particular very complicated because of the role of inflationary expectations. If people expect that prices will go up, what do? They'll go out and buy now. And if they go out and buy now, what happens? Prices go up.
Self-fulfilling promise.
Self-fulfilling prophecy. That's right. And history indicates that once inflationary expectations take hold, it's very hard to reduce them, because this feeling that everything's going to go up in price affects behavior and is self-fulfilling for a while, so people believe it more. And if they believe that there's inflation and act on it, and it produces inflation, then they believe it even more. So, and it's hard, but I mean, there's no measure of well, I mean, there's no way to know what's going on with inflationary expectations or whether they'll be permanent. So these are some of the reasons why it's very hard to predict.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.